Proper functioning of financial markets is a prerequisite of economic growth and development, especially for developing and emerging economies. In this scenario, we will have an overview of financial markets. Financial market, which is the market for credit and capital, can be divided into two. First, money market and then capital market. Money market is the market for short-term interest-bearing assets with maturities of less than 1 year, such as treasury bills, commercial papers, and certificates of deposits are being traded. The major task of the money market is to facilitate the liquidity management in the economy. The main issuers in the money market are the government, banks, and private companies, while the main investors are banks, insurance companies, and pension and provident funds. The interbank forex market is also closely connected with the money market of the financial market. Interbank forex market is the place where currencies are traded between banks. Capital market is the market for trading in assets for maturities of greater than 1 year, such as treasury bonds, private debt securities, namely bonds and debentures, and equities, popularly known as shares. The main purpose of the capital market is to facilitate the raising of long-term funds. The main issuers in the capital market are the government, banks, and private companies, while the main investors are pension and provident funds and insurance companies. Financial market can also be classified according to instruments such as debt market and equity market. Debt market is also known as the fixed income securities market, and its segment are the government securities market, comprising of treasury bills and bonds, and the private debt securities market, comprising of commercial papers, private bonds, and debentures. Another distinction can also be drawn as primary and secondary markets. Primary market is the market for new issues of shares and debt securities, while the secondary market is the market in which existing securities are being traded. Central banks, through its conduct of monetary policy, influences the different segments of the financial market in varying degrees. CBSL policy interest rates have the greatest impact on a segment of the money market called the interbank call money market, and a segment of the fixed income securities market, for example, the government securities market. Reference for today's presentation is from Central Bank's web page titled as Financial Markets Overview. Thanks for watching.